Hi, this is Tim Travis, Chief Executive Officer of TNT Capital Management. It's a Sunday, beautiful Costa de Casa, California. But I wanted to touch just really briefly on bank earnings last week. We saw JP Morgan, we saw Morgan Stanley, we saw Wells Fargo, and we saw Citigroup. And Citigroup rallied about 13% after they reported results on Friday. I think that the market has really underappreciated just how much these banks benefit from rising interest rates via their net interest income. You're seeing, high teens, upwards to 20% growth for a lot of these big banks. They're huge beneficiaries. Citigroup's right there with them. Their ICG business is really operating on all cylinders as far as the markets go. So they have really good trading numbers in fixed income and equities. And their TTS business, which is international treasury and FX and things like that, so that they're really operating well there, and that should be relatively sustainable. Capital markets are extremely weak, so equity issuance, debt issuance, IPOs, there's huge drawdowns there, but it's amazing that with the higher net interest income and the higher markets revenue, they're able to do quite well and are actually growing revenue. I think that when you look at what the concerns are, of course, we could be in an inflationary environment that drives us into a recession. So potentially you could have credit issues down the line. But I think that the market's really underappreciating that Citigroup is very well reserved. So they have about 2.44% of total loans reserved already for provision for losses, and that equates to about 18 billion, a little bit over 18 billion for Citigroup. So they have a huge reserve. Their business is the credit profile of their customers is 80% investment grade on the commercial side. So these are huge multinational corporations with very strong credit. The non-investment grade companies, they're going to demand more collateral. They've done really well when oil sold off in the past and things like that. They've held up really well on the credit end. Where you could see losses for a lot of the banks down the line, and where you saw them in the Great Recession, was credit cards. And Citigroup does have a big U.S. cards business, but they've already got 7.5% of reserves for that. So they're already being very conservative there. And I mean, JP Morgan, for example, they're forecasting their credit card business to only lose about 2% charge-offs this year, probably come in under that. So, Citigroup's might be a little more than that, but probably not much. And so, with unemployment as low as it is, consumers might feel pressured. They might not be comfortable, especially on the lower end, but the very lower end is not Citigroup's client. It's not most of the big banks' clients, and you're going to keep paying bills, doing your best to keep going when you are employed. So we'll see how that situation develops through the rest of the year. Citigroup trades at about $50 per share, which is about 62% of tangible book value, which hovers right around 80. So it's one of the few banks that's actually been able to grow tangible book value with rates going up. Because that pressures AOCI, which is accumulated other comprehensive income. So that just is a headwind that the banks have faced, and Citigroup's done really well being able to grow in that environment, and I think the situation should get better. And then the dividend yield's over 4%. They have to pause buybacks in the short term because they got to meet higher capital requirements with these stress tests that kind of seem to constantly demand more and more capital, which is one negative in the sector. But they'll be in good shape. They'll get there, before you know it. And I'd say when you look at all the banks, I think that Citigroup trades at the biggest discount to intrinsic value. I don't think that it's too rich to say that the stock should trade at 80. I mean, it traded at 80 not even long ago, within the last year. So it easily could get up there, which is well over 50% upside from the current price. So we have a big position. Berkshire Hathaway just bought a big position that we talked about in one of our last videos. And we'll see. Maybe they're adding more. But I think they definitely delivered a shot to Wall Street this last week. And, I'm anxious to see how the year progresses from here. So thank you. We'll continue to provide updates as earnings come through for a lot of companies, and appreciate the time. Talk to you soon.